I pulled $340,000 from my Roth IRA last month. My financial advisor called it suicide. My CPA said I'd regret it by 65. And every finance YouTuber you follow would call me an idiot. They're all wrong. And if you have more than 200,000 in retirement accounts, what I'm about to show you is the difference between retiring at 65 with $2.3 million and retiring at 62 with $1 million. The mechanics no one explained to you, starting now. Here's what we're decoding in the next 18 minutes. 1. Why the Roth is always optimal religion is statistically wrong for 34% of high earners, and the tax bracket math your advisor never showed you. 2. The mega backdoor Roth loophole. How it works, who qualifies, and why Vanguard's interface is designed to hide it from you. 3. The exact decision tree I used to pull that $340K, including the scenarios where I would have kept every dollar in the Roth. I'm not a financial advisor. I'm not telling you what to do. I'm showing you the mechanical reality behind a product that manages $1.3 trillion in American retirement savings, and why the default advice is engineered to benefit the institution, not you. If you've ever felt like your retirement account is a black box designed by people who profit from your confusion, you're right. Let's crack it open. Let's start with the pitch you've heard 1,000 times. Contribute to your Roth IRA. Tax-free growth forever. Compound interest magic. Your future self will thank you. Every finance YouTuber, every robo-advisor, every HR benefits presentation. Same script, same promise. Tax-free withdrawals in retirement. The origin story, 1997 Taxpayer Relief Act. Bill Clinton signs it. Roth IRA is born. Sold as a middle-class win. Let people pay tax now, grow their nest egg, never pay tax again. And the math works on paper. $10,000 contributed at age 25, growing at 8% annually. By 60, you've got $500,000. Zero tax on withdrawal. Beautiful. Traditional IRA, same growth, but you owe 24% tax on withdrawal. That's a $120,000 tax bill. Roth wins, obviously. Except that comparison is rigged because it assumes you're paying the same tax rate now and later. 24% today, 24% at retirement. Apples to apples. But that's not how tax brackets work in the real world. And this is where the entire Roth religion starts to crack. Here's what your advisor never showed you. Right now, if you're a high earner, let's say married filing jointly, $200,000 household income, you're in the 32% federal marginal bracket. Live in California, add 13.3% state tax. New York, 10.9. Your marginal rate, the tax you pay on the next dollar you earn, is 45% combined. That's what you pay when you contribute to a Roth. 45 cents of every dollar goes to the government today. Now fast forward to retirement. You're 65. You withdraw $120,000 from your Roth. Tax-free, right? Sure. But let's compare that to the traditional IRA scenario everyone says is worse. You withdraw $120,000 from a traditional. That's your only income. No W-2, no side hustle, just retirement accounts and Social Security. First, $29,000, standard deduction for married couple. Zero tax. Next, $23,000, 10% bracket, $2,300. Next, $68,000, 12% bracket, $8,000. Total tax, $10,300. Your effective tax rate, 8.6%, not 32%, not 45%, 8.6%. So let's do the actual math no one shows you. You contribute $340,000 to a Roth over your career. At 45% combined rate, you just paid $153,000 in taxes today. Alternative scenario, you contribute that same amount to a traditional. Pay zero tax now. Let it grow. Withdraw it in retirement. at 8.6% effective rate. You pay $29,000 in tax. You just prepaid $124,000 to avoid taxes. That's not tax optimization. That's financial illiteracy wrapped in conventional wisdom. But wait, your advisor says, tax rates might go up in the future. Maybe. Top marginal rate was 70% in 1980, 50% in 1986. Now it's 37. We've had 70 years of data. Rates fluctuate, but your effective rate in retirement is almost always lower than your marginal rate during peak earning years because of how progressive brackets work, because you're not earning W-2 income, because you control your withdrawal rate. Second variable, no one mentions. State tax arbitrage. You contribute to your Roth in California. 13.3% state tax on that contribution. Gone. Paid forever. You retire in Florida. 0 state income tax. If you used a traditional, you pay California tax on the way in at your high marginal rate, then pay 0 Florida tax on the way out. $340,000 contribution. California tax, $45,000. You just donated that to Sacramento to save $0 in Florida. That 45 grand invested at 8% for 20 years, that's $209,000 you vaporized. Third variable, and this is the one that actually made me pull the trigger, liquidity lockup. Yes, Roth contributions can be withdrawn anytime, tax-free, penalty-free. But be honest, when's the last time you touched your Roth? Never. Because psychologically, it's labeled retirement money. It's in the mental vault. Untouchable until 59 and a half. So that $340,000, it's locked. Can't use it for a down payment on a rental property that cash flows $4,000 a month. Can't deploy it into a business acquisition that doubles in 3 years. Can't access it for an emergency without paying penalty. Opportunity cost is invisible, but it's real. Every dollar locked in a Roth is a dollar that can't be deployed for higher return, tax-advantaged alternatives that become available between age 40 and 59. Now, before you go liquidate your Roth, here's when it does make sense. Roth is optimal if you're in the 12 to 22% bracket now and you expect to be in the 24 plus bracket in retirement. That's rare, but it happens. Inheritance coming, pension, late career income spike. Roth is optimal if you're under 30 with a 35 plus year horizon. Time heals the tax overpayment. Compound growth eventually overcomes the upfront hit. Roth is optimal if you live in a 0 tax state now and plan to retire in a high tax state. Inverse arbitrage works in your favor. And Roth is optimal if you've already maxed every other tax advantaged account. You're sitting on excess cash and you have no better deployment options. But if you're in the 32% bracket or higher, if you need liquidity in the next 10 to 15 years, if you live in California or New York and plan to retire in Texas or Florida, if you have access to better tax vehicles like cost segregation or self-directed accounts, the Roth might be costing you 6 figures. But here's where it gets interesting. There's a version of the Roth that lets you bypass the $7,000 annual limit. It hides in plain sight inside your 401k interface. Almost no one knows it exists. It's called the Mega Backdoor Roth. And it's the reason I was able to move $340,000 in a single year when the official limit is $7 grand. 2 minutes. We decode it. Right. The Mega Backdoor Roth. If you've heard the term, you probably think it's some sketchy loophole that'll get you audited. If you haven't heard it, you're about to learn why Vanguard and Fidelity actively bury this option 3 menus deep in your 401k dashboard. Here's what it actually is. In plain English, the IRS sets 2 limits on your 401k. Everyone knows the first one, $23,000 in employee contributions for 2024. That's the number every finance article repeats. But there's a second limit almost no one talks about. The total annual addition limit. That's employee contributions plus employer match plus after-tax contributions. And that number is $69,000. $69,000, not $23,000. The difference between those two numbers, $46,000, is the invisible space where the mega backdoor lives. Here's the mechanic. The IRS allows your employer's 401k plan to accept after-tax contributions, not Roth, not traditional pre-tax. A third category, after-tax dollars that go into your 401k, sit there briefly, and then, this is the key, convert immediately into Roth. You contribute after-tax money. The moment it hits your account, you execute an in-plan Roth conversion. Now, those dollars are in Roth. They grow tax-free forever. You just bypassed the $7,000 Roth IRA limit and moved $30,000, $40,000, $50,000 into Roth in a single year. That's the mega backdoor. This isn't a hack. It's not aggressive tax planning. It's written into IRC Section 402G and 415C. It's been legal since 2010. But if you call Vanguard and ask about it, the first tier customer service rep will have no idea what you're talking about because only 6% of their users ever find it. Let me show you why. This is Vanguard's interface. To enable after-tax contributions, you go to your contribution settings. Click Additional Options. Scroll past the giant blue button that says Increase Your Savings. Click the tiny gray link that says After-Tax Contributions. Read a 2-paragraph legal disclaimer. Then you can opt in. Fidelity hides it under Brokerage Window Options. Schwab calls it Voluntary After-Tax Contributions and buries it in a PDF. Why? Because the moment you start using this strategy, you ask questions. You call support. You want confirmation you're doing it right. And that costs the institution money. So they designed the interface to ensure only the most financially sophisticated users ever discover it. Now, who actually qualifies? 3 requirements. 1, your employer's 401k plan must allow after-tax contributions. Not all plans do. About 38% of Fortune 500 companies offer it. Most small businesses don't. You need to check your summary plan description, the SPD, or ask HR directly. The exact phrase is, does our plan allow after-tax non-Roth contributions? 2, your plan must allow in-plan Roth conversions or in-service withdrawals. This is critical. If you can contribute after-tax money but can't convert it to Roth, it just sits there growing taxable. That's useless. You need the conversion mechanism. 3, you need to be below the 415C total limit. If your employer match is huge, say $15,000, you have less room for after-tax contributions. Do the math. $69,000 total minus your $23,000 employee minus employer match equals your after-tax space. Only about 12% of American workers have access to all 3 components. And of that 12%, 70% don't know it exists. This is a high earner strategy. The average mega backdoor user makes over $280,000 a year because if you're making $60,000, you're not maxing your $23,000 employee contribution, let alone adding $40,000 more. So here's my story. From 2019 to 2022, I mega backdoored $38,000 a year. 4 years, $152,000 total. I was working a W-2 tech job, 32% federal bracket, stable income. My plan allowed after-tax contributions and quarterly in-plan Roth conversions. I set up automatic contributions, $2,000 per paycheck, and converted every quarter to avoid any taxable gains in the after-tax account. Standard execution, textbook strategy. Then 2023 happened. I left the W-2. Started consulting, launched this channel, income dropped to $140,000, marginal rate fell to 24%, and suddenly I had access to better tax vehicles. Self-directed solo 401k, cost segregation on a rental property I bought, qualified business income deduction, oil and gas partnership that generated passive losses. I ran the numbers. Keeping money locked in a Roth growing at 8% index returns was good. But redeploying that capital into cash flowing real estate with depreciation shields and 20% down payment leverage was better. So I used IRS Rule 72T, substantially equal periodic payments. It's a mechanism that lets you withdraw from retirement accounts before 59.5 without the 10% early withdrawal penalty, as long as you follow a strict formula and take equal distributions for 5 years. Or until you're 59.5, whichever is longer. I pulled $340,000. The contributions came out tax-free and penalty-free. That's always allowed. The gains, about $190,000, got hit with 24% income tax plus 10% penalty, 34% total. Tax bill on gains, $64,600. But here's what I did with that $340,000, $200,000 down payment on a 4-unit rental property in Austin. Cash flow, $3,200 a month after mortgage, taxes, insurance, maintenance reserve, cost segregation study, $85,000 in accelerated depreciation. That's $85,000 in paper losses I used to offset the Roth withdrawal tax. Net tax paid after depreciation shield, $18,000. Remaining $140,000, emergency fund and liquidity reserve. 10-year comparison. If I left the $340,000 in Roth growing at 8%, $734,000. If I deploy into rental property, $384,000 in cash flow over 10 years, plus $160,000 in conservative property appreciation at 3% annually, plus the liquidity value of having $140,000 accessible, plus the tax bracket arbitrage I got from contributing at 35% and withdrawing at 24%. Total value, $690,000 in cash equivalents, plus avoided $57,000 in overpaid taxes from the original Roth contributions. I'm ahead. Not by a lot, but I'm ahead. And I have liquidity and I control the asset. Now, here's what I'm not saying. I'm not saying you should do this. I'm not saying Roth is bad. I'm not saying everyone should pull money out of retirement accounts to buy real estate. I'm saying the financial advice industrial complex sells you one strategy. Max your Roth, hold forever. Because it's simple, repeatable, and generates compliance. It works for 80% of people. But optimal strategy is personal. It depends on your current tax bracket, your expected retirement bracket, your state tax situation, your liquidity needs, your access to alternative tax advantage vehicles, your risk tolerance, your time horizon, your ability to actively manage investments. And no robo-advisor will ever ask you those questions. No advisor who gets paid a percentage of assets under management wants you to reduce the assets they manage. So here's the framework I used to make this decision. If you're sitting on a Roth balance, mega backdoor or otherwise, and you're wondering whether conventional wisdom applies to you, this is your decision tree. Next 3 minutes. Exact spoken text. So that's the mechanical reality behind $1.3 trillion in Roth accounts. The conventional wisdom isn't wrong for everyone. It's just not right for everyone either. And the system profits when you don't ask questions. If this decoded something your advisor never explained, hit subscribe. Next video drops in 72 hours. Why your 401k match is costing you $43,000. The vesting schedule trap no one reads. Drop a comment. What's your Roth balance? And are you questioning it now? I read every single one. Until then, question the default. See you inside.